Ladies and gentlemen, good morning. As always, we start our review of the week that was and what is likely to happen next week by looking at the US fixed income market and the yield curves. As you can see, the 5-year note is now absolutely stuck at around a yield of 1.85%, which has been a trading area since basically the December, late November, early December of last year. We just seem to be unable to move away from that magnet. Now, this level of 118.03 and a half is a level that we drew back months ago as exceedingly important. And look at what happened last week. It went to it like a magnet, tried to break through underneath it, and failed. The Bollinger Bands are now contracting. The 200-day moving average is still coming down, while the 50-day moving average is coming up. You will see that that is a feature of nearly everything we will look at this week. This movement up of the 50-day moving average, down in the 200, and the market stuck in between them. So what is likely to happen next week? Well, more of the same. 118.03 and a half in 5-year notes is going to be extremely tough to break on the downside, but this level of the highs around 118.30 is also going to be extremely hard to break. So we see more range trade with 118.03 as the bottom and 118.25 to 30 as the top, which would give you a yield trade of between 1.87 and 1.70. That is your range for next week. Exactly the same thing can be seen in the 10-year notes. If you have a look at what we have here is exactly the same type of price action. The market stuck between a 50-day moving average and a 200-day moving average. Bollinger Bands compressing, indicating more range trade, this time between 233, 235 in yield, and the low around 215 in yield. This is the area that we will be trading in for quite some considerable amount of time before we can break out. Now, if you have a look at the price, this level of 125.09 we drew again months ago as extremely important, and every time it tried, and it tried every day last week, it was supported and held. This tells us that we are more likely to go slowly in this direction up towards 126.30 and make new highs than we are to break down. But at least we have our levels both in 5-year notes and in 10-year notes. If we look at what's happening in Europe, these are weekly charts, and this is a weekly chart of the Schatz, the 2-year sector. We will see that the Bollinger Bands have now gone completely flat. Moving averages and Bollinger Bands flat, which basically means the market is stuck in a range of minus 90 to minus 65, and until we break either level, the market is in complete and utter indecision for the foreseeable future. We are now stuck for a considerable period of time. 5-year note, exactly the same. These levels around minus 28 to minus 25 are going to be extremely difficult to break, and as we suspect is this level around minus 53 to minus 55. indecision for the foreseeable future in the European and in US fixed income. This is now the Bund. The Bund is stuck very much between 50 basis points on the upside and minus 15 basis points on the upside. What is likely to force a break either way? Well, it's going to have to be either inflation news or fundamental economic news or some kind of announcement from a central bank like the ECB that they will move their QE additions lower, but that we don't expect until June. So we have a considerable period of time in which the market is going to range trade before deciding on the next move. Given that we have both EU and US fixed income markets stuck, as we have shown you, we have a unlikely move much higher in Euro USD, since Euro USD is actually at the moment nearly entirely driven by expectations of next moves in fixed income in the relative countries. We think that it is more likely than not that we will be very strongly capped by 110.65. This level has been the magnet for certainly for the past 2 years in Euro USD. So we expect 110.65 to cap it for a return towards the 50-day moving average around the 107 level. So we have a 2% trading range that we think is going to hold for quite some time. And this is very much reflected in the DX, the dollar index. We can see that the dollar index is very perilously poised on the 200-day moving average and on this trend line which has caught it all the way since last year. What is interesting is that the dollar index is the one that has nearly given up all the gains from the Trump rally. It is the one that has shown least faith in the Trump policies, followed by bonds, followed by equities, i.e. equities are the ones placing the most faith in a Trump reflationary policies, while the dollar is the one which is the most skeptical. This, as you can see, is a chart of the 5-year note yield and a chart of the dollar index. As we expect this to break somehow somewhat lower in limited ranges, we would expect the same to happen in the DX. But we don't think the move is going to be very significant. We have a level here at 96.50, which has been very important for many years now. We would not be surprised to see a slow test of that level, but it would definitely hold it. We don't think it's going to be a break of this trend line, and the 200-day moving average is going to be a process of trading between par and 97, where many months, probably the whole of the summer, is going to be spent trading sideways in that 3% range before we can expect a further trend-like move into the autumn. Moving on to equities, if we just blindly looked at this chart of ES, this is a weekly chart, we could say this is a bull flag which we have broken to the upside, and we are about to go up to at least 24.15 next week. Well, yes and no. We are not believers at this stage, simply because we think that the ES is going to be almost exclusively a factor of XLF. If we look at a chart of XLF, we will see that things are absolutely not ideal. This is a daily chart of XLF with very clear levels, 2286 on the downside and this level that capped it last week, which is 24 on the upside. You can see how all these moving averages are bunched up at 24 and held it last week, and you can see how 2286 has held it since basically the beginning of the Trump rally. And this again looks exactly like the chart of the 5-year note. We expect that we will test 2286 at some stage over the course of the next couple of weeks with this very important trend line. If that is the case, we just don't see how ES can go higher, given that the XLF is so weak. This is by far the weakest sector within ES, but also the largest sector within ES. Therefore, it is extremely unlikely that we will break higher in ES without help from XLF, which basically means that we are not trading ES, we are trading XLF. If XLF can break above 24, then yes, we will definitely want to be long of ES. But if it now goes and tries and tests 2286, we are convinced that the ES will actually trade lower, down to 2330 at best. And this is a chart of XLF with our early warning of the yield curve, which is the T-bills minus the 5-year note, i.e. basically an indicator of future profitability in the banks. It's taking some time to turn these moving averages, but this just does not look good. We are now back in the range that we were before the Trump victory, i.e. the level of future profitability of banks is now at the same level as before Trump. So everything that he has said and blustered about the market has discounted and gone back to where he was before he opened his mouth. That to us indicates that the probability of XLF breaking higher without this moving significantly higher to at least this level of 13 is very low. It is more likely than not to eventually break down and fill these gaps on the way up, which are all the way down at 22, which is a big move. And therefore we are at the moment quite bearish of ES and TF for a move down in the order of 3 to 4%. If we look at our other indicators, we will see that more or less they're all stuck between the 50-day moving average and the 200-day moving average. This important indicator, which is SPY over IEF, which basically says should I be in equities or should I be in bonds, is now going sideways and just whipping around. We suspect it's more likely to make a move down towards support than it is likely to make a move higher, taking out these highs. So we think it's more likely that the market will want to be in bonds rather than in equities. This is the same move This is the same chart in SPY over TLT, i.e. the longer term bonds, exactly the same story. We think it's more likely to test the downside, having tested from below the 200-day moving average, rejected it on Friday. We think risk off for the next few days is more likely than risk on. And again, to see how important XLF and the whole financial sector is, this is a chart of TF, which is the Russell, which has probably the largest component of financial stocks in its index. Now, it broke up. It had a wonderful chance to keep on going last week, and on Friday just gave up all the gains of the week. This tells us that we are more likely to go sideways than we are to go up straight away. Therefore, it is quite obvious that we are not trading any index apart from XLF. It is the only game in town at the moment. XLI is strong, XLK is strong, and probably will just move sideways to slightly higher. But it's XLF which will decide the fate of the indices next week. If we look at the commodities to give us some validation for higher yields and why XLF should go up, well, we don't get very much. Everything is stuck towards the lower levels of the Bollinger Bands. We see absolutely no bounce at all that we can see that is imminent in the commodity markets. Oil is weak, gold is weak, sugar is weak, softs are weak, wheats, agriculturals are weak, everything is weak. That is why we see absolutely no inflationary pressure. Everything is stuck between the 50-day and the 200-day moving average. And as such, we think it's more likely that the yield curve continues to flatten rather than steepens, and therefore we see very little support for XLF. For us to get bullish of XLF, we need to see a clear breakdown in the yield curve. This is the 5-year to 30-year spread, and as you can see, it is just meandering around. It is making no attempt to break higher in as a steepening move. It is within 3 basis points of being at the lowest level it has been in its history. That is just not an indicator that we are about to have a move in XLF to the upside. That's why we just can't get extremely bullish of any of these indices apart from NQ, which is, so heavily technology weighted that it can ignore XLF. And finally, if we look for confirmation from anything else like HYG, which is junk, over TLT, which is treasuries, we get the same picture. A market stuck between a 50-day moving average and a 200-day moving average, and on support. More indecision than that you just couldn't hope for. These markets and these spreads are telling you nothing at all, which basically is telling us that XLF is the key to everything. If XLF breaks, the markets will break with it. If XLF goes to the upside above 24, it will enable all the indices to make a move higher. But for that to happen, the spread between 13-week bills and 5-year notes needs to change considerably, and therefore the the next move in indices is going to be very much in the hands of the yield curve. If you needed any more confirmation of what we've just been saying about the importance of XLF, look at a chart of XLI over XLF. This is the break that we highlighted a couple of weeks ago, and it is now back towards the 200-day moving average. If it now breaks through it, we will have basically erased the whole of the Trump rally in XLF against XLI. And you can see what a brutal move it was. And that will be yet another indicator, if one is needed. We have DX showing you the way, we have the bonds showing you the way, we have the spreads, internal spreads showing you the way. If XLF now gives up the ghost, we think equities are likely to retrace a good 3 to 4% back down towards the 2330 level at the very least, if not 2280. It is a good thing that we see such indecision in the markets because it gives us very definite trade points. In the 5-year and 10-year notes, as we see, we are still favoring an eventual retracement and test of the 0.382 level. The breakpoints against this thesis are very, very clear. Close below 118.03 in the 5-year notes or 125.09 in the 10-year notes will say that we are going higher in yield, and therefore XLF is a buy. If XLF is a buy, we know that all the indices are going to follow it, because XLF has been the one weighing on the indices and not allowing them to move higher. Bund and Bobble, we're coming into the final of the French elections. Markets will still be jittery, and only next month we think that the markets can start breaking down somewhat. Overall shorts, still poor risk reward here. We're in the middle of a range. We would much rather see a break of those ranges to get very short before we do anything else. Now, watching these commodities indices, it's telling us absolutely nothing. There is no reflation according to commodities. We are still in the super cycle down, which basically makes us think that any moves to much higher yields are unlikely at the moment. ES, we still think we're in some sort of fourth wave. 2320 to 35 is very strong support, and XLF is absolutely the key. I mean, next week do nothing but watch XLF. Don't trade ES without looking at XLF. The levels are very clear in XLF. A close above 24 and we will have a very nice run in ES. On the other hand, a close below 22.81, and we'll definitely see a retest of 23.20, if not all the way down to 22.80. NQ is the only sector in trend. You have to be overweight technology because it is far too strong to short. We made that mistake last week. We're not going to repeat it. Every time NQ drops, we will be buying it against some other sector, probably XLF. Russell 2000 is the sector most exposed to financials. It should be the preferred. I mean, let's put this in. Should be preferred long instrument if the Trump trade is in existence. But it is not performing. Therefore, it is quite obvious that the Trump trade is on its last legs. Any close below 1340 is a stop on all longs, and close below 1333 indicates that we are in a sell-off phase for the entirety of the equity sector. European equities, we need to digest the massive move we had last week. We think it is more likely to play some range and go down 1 to 2% next week than to continue the rally. And DX, well, we don't think there is going to be a big move in the next couple of weeks, as we showed you, but eventually we think the move is more likely to be on the downside than on the upside. and we think that from now on any weakness in the relationship between stocks and bubble is going to be a buy, because we think we are over the hump. We will be telling you over the course of next couple of weeks where we put our trades on. We definitely want to be long of European equities rather than European fixed income at some stage over the next couple of months. That is all we have for you today. Please watch XLF next week. It'll tell you all you need to know about the direction of the stock market indices. Thank you very much indeed, and see you on Monday.